All right, welcome to This Explainer. Today, we're diving into the fascinating and honestly kind of contradictory Q4 earnings of data patterns. If you follow the defense sector at all, you know that headline numbers almost never tell the whole story, right? We're going to look way past the market's immediate knee-jerk reaction to uncover the actual strategic performance of data patterns in fiscal year 26. We're talking about a recent revenue dip, their absolutely incredible margin resilience, and what is shaping up to be a massive upcoming order pipeline. Let's get into it.
Okay, so let's kick things off with the immediate reaction from Wall Street. Right after releasing their Q4 results, Data Patterns saw a sudden 4% drop in their stock price. You know how it is. The market absolutely hates surprises. And this drop was triggered by an unexpected top-line miss that totally caught analysts off guard. But when we're dealing with the world of complex defense contracting, those knee-jerk reactions, they usually miss the bigger picture entirely.
So, picture this. The financial news tickers are flashing red as Data Patterns reports a 13% year-over-year decline in Q4 revenue. Their quarterly revenue dropped down to 345 crores. That completely missed the street estimates, which, by the way, had actually predicted a 4% growth. So just on the surface, seeing a double-digit revenue contraction for a major defense player, well, it looks like a pretty serious red flag.
But hold on a second, because this brilliantly illustrates the real story. While that top-line revenue was shrinking, their Q4 EBITDA actually surged by 29% to hit 193 crores. So not only did earnings jump, but their net profit also climbed to 138 crores. It's wild, right? This is the ultimate contradiction that we really need to unpack today. Just take a look at this. Revenues contracted by 13%, and yet profits and margins absolutely exploded. I mean, their EBITDA margins skyrocketed from 38% last year to a massive 56%. That is a staggering 1,800 basis point expansion in just a single quarter.
So you're probably asking yourself the obvious question. How on earth does a defense contractor manage to squeeze so much more profit out of a shrinking top line? Well, Data Patterns completely flipped the script this quarter, and the secret really lies in exactly what they are building. The answer is hiding right here in their material costs. Listen to this. Last year, material costs ate up 51% of their sales. This quarter, that number plummeted to a mere 27%. When your costs drop that drastically, your profitability naturally just goes through the roof. But here's the thing. This wasn't just luck, and it wasn't just finding cheaper raw materials. This was a highly intentional shift in their entire business model. And this hits the nail right on the head. It aligns perfectly with what analysts over at Choice Broking recently pointed out. A relentless focus on owning the design gives you massive pricing power. Think about it. When you control the design from the ground up, you aren't just acting as a middleman passing along expensive parts. You are the one creating the intrinsic value, and that completely insulates your margins. Which brings us straight to their IP-driven strategy. Management has been crystal clear about this. They are purposefully shifting away from those low-margin trading and pure integration contracts. Instead, they're transitioning to developing full system solutions entirely in-house. By building custom electronics backed by their own proprietary intellectual property, stuff like advanced radars and avionics, they have effectively bulletproofed their bottom line against competitive pricing wars. It is literally a textbook example of how owning the IP creates structurally superior margins. Because of this strategic shift, analysts have a highly positive view on the sector right now. Why? Because Data Patterns now operates in a very specific, niche space that comes with high control and super limited competition. They are deeply embedded across India's most critical defense programs. And let's be real, when you are the sole provider of a mission-critical, heavily engineered electronic system, you get to dictate the terms. Now, let's take a step back. When we zoom out from a single quarter to the entire fiscal year, the narrative gets even stronger. Defense contracting is notoriously lumpy, right? You just can't judge a company like this by a tiny 90-day window. That Q4 miss was simply a temporary timing issue. The actual FY26 reality is a compelling story of sustained operational excellence and compounding revenue streams. And the numbers back this up flawlessly. That scary Q4 dip completely vanishes when you look at the full FY26 record revenue from operations, which came in at an incredibly impressive 925 crores. That represents a stellar 31% growth for the entire year, which actually significantly outpaces their own medium-term guidance of 20 to 25%. Looking at the full-year data proves that the overarching growth narrative is entirely intact. Revenue jumped from 708 crores to 925 crores.
EBITDA soared from 275 crores to 371 crores, maintaining a really robust 40% margin for the year. And profit after tax grew solidly to 271 crores. So they aren't just growing, they are scaling incredibly profitably. But honestly, what you should really take away from this explainer is the mind-boggling scale of their future order pipeline. Past performance is great and all, but the stock market is a forward-looking machine. And right now, Data Patterns has positioned itself at the absolute edge of a massive influx of defense spending. Currently, their officially reported order book sits at a very healthy 926 crores. However, their actual effective pipeline, meaning the deals they are actively working to close right now, is a staggering 2,062 crores. This is literally the largest pipeline in the history of the company, offering incredible revenue visibility for the years ahead. Let's actually break down that timeline, because things are moving fast. Over the next 60 days alone, management expects to sign off on 1,090 crores in fully negotiated contracts. Looking out just a bit further, over the next 12 months, they're expecting around 1,900 crores in repeat, single-vendor production contracts based on products they've already successfully delivered. This sets up FY27 for an incredible projected 25 to 30% revenue surge. And we aren't just talking about basic nuts and bolts here. These upcoming orders are highly strategic, mission-critical systems. We're talking about supplying critical seekers for the BrahMos missile, developing advanced electronic warfare suites, and building complex radars. Plus, they're actively expanding their export momentum. They currently have an export order book of 53 crores and are pushing hard into the US and European markets. They are practically partnering with giants to build out a much larger Indian defense ecosystem. So to wrap up our analysis today, I want you to remember these three key takeaways as you look at this space. First, look past the headlines. That 13% quarterly revenue drop completely masked a massive 31% full-year revenue surge. Second, IP equals margin. Bringing design in-house is exactly what drove those Q4 EBITDA margins to an astonishing 56%. And finally, keep a close watch on that order book. We're expecting over 1,000 crores in negotiated contracts to hit in just the next 2 months.
Which leaves us with one final provocative question to chew on as we watch this defense giant evolve. When a company fundamentally transforms its profit margins and is sitting on the largest order pipeline in its history, is a short-term revenue shock actually a long-term opportunity? Thanks for learning with us today on this explainer. We'll catch you next time as we continue to decode the real stories hidden in the data.